Let's talk about corporations and piercing the corporate veil. This may have been a bit confusing to you when you read it in the book. I hope I can make it less confusing. What the writers are getting at with piercing a corporate veil is that the corporation has a shield against liability. In other words, the fact that you are not, as a shareholder, personally liable for the business debts, that's like a shield of protection for you. And you will lose that protection if you've abused the right, if you've abused the privilege of creating and operating a corporation. Because from the state's perspective, they gave you a big benefit here. They gave you the right to create this limited liability organization, the corporation. And if you've abused that right, they'll strip you of the protection, and they'll call that piercing the corporate veil. Now, when will this happen? It generally occurs if two things have happened. First, if there is domination by the corporation, by its shareholders, so that the corporation isn't acting in its best interests, but instead is an instrumentality for the shareholders' own benefit, not for the business's benefit. Remember that the corporation is legally considered a separate person, and in corporate management, the corporation's best interests are supposed to be promoted. This theory is sometimes called the alter ego doctrine, where you're really not observing the corporation as a separate entity that exists for the good of the company and its shareholders, but instead as your little playground to manipulate as you wish if you're a controlling shareholder. The second requirement is that the corporation is being used for an improper purpose. Well, what are some examples of this? Inadequate or thin capitalization might show that there is domination and may also show that there is an improper purpose. I'll give you an example of this later. Commingling funds. This means mixing up the business funds. The typical scenario is that there's a shareholder who's using the corporate funds for their personal purposes and or vice versa. And there's not the separateness that should occur. Failure to observe corporate formalities, for example, never having shareholder meetings, never keeping minutes, never notifying the shareholders of anything. It doesn't even look like a real corporation because you're not following any of the rules. Improper purposes could include defrauding creditors, looting the corporation, taking all of its assets for your personal benefit, to avoid paying off corporate debts. Avoiding regulatory law might be considered an improper purpose. Here's an example. Suppose that Rick owns 100% of the stock of Rick Inc., and there are three directors: Rick's 80-year-old mother who has Alzheimer's, and Rick's 19-year-old daughter. And if you think I'm kidding, think again. Once I had a student who told me that one of the directors of his family's corporation was their dog. They named the dog. Haha. It's very funny until you get sued. So don't fool around with this. Create directors who look like they can really act in the best interests of the corporation. Okay, back to the story. Rick regularly commingles his personal and corporate funds, at one point transferring most of his personal assets to the corporation to hide them from his wife during their divorce proceedings. He uses corporate assets for his personal use. In other words, he uses the corporate credit card when he goes out for his vacations, for his car payments. Has the corporation pay him rent on the house he owns and uses only for personal purposes, etc. All of this, of course, is improper. Now Rick gets sued by a creditor, and Rick, anticipating the judgment against him, pays out all of the company's revenue as, let's say, a shareholder dividend. To who? Well, there's only one shareholder. That's Rick. So the corporation has no assets. In the lawsuit, creditor versus Rick, what result? A court is very likely to pierce the corporate veil, to say that there is a lack of separateness between Rick and the corporation, because there's no effective oversight with the mother with Alzheimer's and the 19-year-old daughter. The lack of separateness with the financial affairs that is required under corporate law, and the misuse of the corporation by using its assets for his personal use and trying to evade the corporate obligations. All of that taken together would lead a court to say, we will pierce the corporation's veil and hold Rick personally liable for the business debts. We referred earlier to thin capitalization or inadequate capitalization. Now here's a problem. Suppose that Caroline starts a business called Indie Fabrics Inc. with a $50,000 contribution. In hypothetical number 1, Caroline issues herself 50 shares at $1,000 per share. This year, after expenses, she has $40,000 left, and she does not want to reinvest that money in the business. What is the tax consequence? Let's assume that there's a 10% marginal rate in all of our examples just because it's easy to calculate that way. Well, Caroline will probably pay herself $40,000 of either bonus or salary. Now, she could pay it to herself as dividends, but think about why she doesn't want to do that. If she pays it in the form of a salary or bonus, she avoids double taxation. The corporation can write it off as an expense, and she can then pay taxes on that money only once. So her tax consequence in this hypothetical would be $4,000. By contrast, if it was paid out as dividends, then the corporation has to pay a tax on the profit, and then Caroline will have to pay tax on what's left of that money that's paid out as dividends. So, at any rate, if she pays it to herself as salary or bonus, she pays $4,000 of taxes. In hypothetical number 2, Jennifer issues herself 50 shares of stock at $2 per share. She then lends Indie Fabrics $49,000 at 5% interest. Now notice that Indie Fabrics has ended up with the same amount of money as it did in the first instance. In the first hypothetical, Caroline started with a $50,000 contribution, meaning she was buying shares worth $50,000. In the second example, she has again put $50,000 in, but $49,000 of that is a loan. Let's suppose that this year, again, Caroline has $40,000 net that she wants to pay out to herself. How is she going to do it? Well, what if she calls that $40,000 repayment of a loan? If it's repayment of a loan and not salary, not bonus, not dividends, is there a tax consequence? No. Why? Because the extent that you were just repaying the capital that you lent, and that originally was $49,000, to that extent there's no gain. You're just getting back what you lent. There's no tax event because there's no gain. There will be some small amount, 5% of it, that you've agreed to pay taxes on because of the interest, but that's peanuts. Well, if you figured all this out, and I figured this out, who else has figured this out? Right, the IRS. They have figured out that calling huge chunks of investment loans rather than the purchase of shares results in tax avoidance. The IRS does not like this, and the IRS may well come in and say, you are too thinly capitalized and you are mischaracterizing some of the capitalization of this company as a loan instead of as a capital contribution. What you look for is the debt to equity ratio. How much debt is there compared with how much equity? In hypothetical number 2, the debt equity ratio is 49-1, and that, in the IRS's view, is really high. What's going to happen? The IRS may disallow those loan repayments as disguised dividends, and they could impose penalty and interest and other bad things. In addition, what else could happen with thin capitalization? As we saw previously, the alter ego doctrine might apply because it might look like you are misusing the corporation for your personal purposes, dominating it for some improper purpose. So that doctrine may well apply so that you lose the benefit of the corporate shield. Finally, another problem is the deep rock doctrine. It's possible, if courts view you as being too thinly capitalized, in other words, a huge amount of loans and relatively low amount of capital contributions, that they will give creditors preferences, and they will say here that we have an outside creditor and then we have a shareholder creditor. In that last hypothetical, Caroline was a shareholder creditor because she loaned money to the business, and they'll say, nope, we're going to pay the real creditors, the outside creditors first, and we will pay off the shareholder creditors like Caroline only after the outside creditors get paid first. We will, in other words, subordinate Caroline's debt to that of the outside creditors. Again, that doctrine is called deep rock.